Hey, welcome everyone to Drippy Verse. And in this video, I want to talk about option selling and how we can use this to create income, and also actually as we trade the SPX 0DT lottos. I will link the video of other recaps for SPX 0DTEs, but in this, I'm gonna focus on the selling side of options, which is different than buying options. So, um, just to give you a quick example, when you click on your broker and when you buy an option, let's say you think that SPX is going to break out here, and you buy 4050 call on the breakout, right? So you're buying the call because you think it's going up. And on the other hand, let's say you think that SPX is going to go down from this resistance area. So you buy puts, and that's the essence of it, right? If you think it's going down, you buy puts. If you think it's going up, you buy calls. So both of these have one thing in common, is that you are buying theta. What I mean by that is you are buying an option premium which has essentially theta baked in it. What that means is that as time passes by, these options are losing their value. If the price was to remain stable, these options, let's say you got 4050 call, right? The price, if the price was stable here, these premiums will go to zero. And the reason is that as time passes by, your theta eats away your premium. The probability of it reaching 4050 is decreasing as time passes by. Let's say if it was flat, but in this case, market was ripping, right? So I missed the long side, of course, because this is something you cannot really predict in the market, and SPY was already extended, way extended. I mean, this is 5-minute chart, so look how big of a move we had. This was today, so look how big of a move we already had. Right around 2 o'clock, we had almost 69-point move since yesterday's low, right? And since yesterday's close, roughly around this area, we had how much? 62-point move. So already a big move. So in terms of ATR, let's talk about this. Is ATR levels indicator. So this is the blue line here, right? The blue part, which means that calls above this. So we gapped up, and then of course we were consolidating around the mid fib level. You see mid fib level here acted as support 1 time, 2 time, so many times, right? So they were buyers here. So of course I wouldn't be interested in going long looking at these chop here, and it ripped so fast in 2 minutes. We were from what is it, in 10 minutes we moved from here to here, like, so big move on SPY. And I wasn't into buying calls because the premium were very expensive for calls. So in my mind, I was thinking that, okay, I think as we approach close, I would love to sell some premium, right? Because it's so extended already. So if we start to see weakness into close, I can sell some of the premium, and that way it's a lower risk than buying puts, because these can get cooked, right? If you buy puts, they can go to zero instantly, or we could just consolidate into the day, right? So in my experience, right, if we consolidate and you sell higher delta, let's say you sold 4050 call, and even if you consolidate, those calls would probably go to, like, whatever the price is here until close, like back to zero, right? If they're out of money, that's what happens, right? So let's look at the actual trade. I'm gonna go in depth on these sometime in the future. I'll create a whole series on this topic of selling options. So please make sure to hit the like button and subscribe to the channel if you guys are interested in the whole series of selling options from the basics to the advanced level, and especially focusing on SPX 0 DTE, because this allows us to create like income without having to worry too much about like what if I get stopped out of the trade and etc. I mean, there is a stop loss here as well, but chances of it getting triggered is much lower than when you were, let's say, in the calls. Let's say you were buying calls, right, at the breakout, and if you had a very tight stop in this chop, you would have stopped out, because SPX 0 DT premiums move very fast. So unless you have, let's say, 30-40% stop loss, these can move wild, right? So, and I will show you too. So let's move on to the 1 minute time frame. So this was 5 minute time frame, and so notice here that around 3:30. So let's go here, right? Let's talk about this here. So quickly, again, this is the this is sorry, not the multi-day. Let's go to the daily late ATR level, and when you look at this, we had 40-40 as basically one ATR extension from the call trigger, right? So already extended, and we were kind of following these levels here, the fib levels. So I thought, okay, if you're following the fib levels, there's a chance we could follow here. So in my mind, okay, I was gonna open at 40-40, like a bearish spread. And what I mean by that is I want to open, basically this was my reasoning behind the trade. So right around this level, right around this time, let's 3:31, right? So reason for bearish stance, way too extended from 21 EMA on the 5 minute, way too extend on the day. We were against the multi-day, the daily ATR extension. So 40-40 in my mind was a decent area. So I decided that, and this was right around 3:30. So I was thinking that maybe if we have earnings for Meta, we might see some sell-off, especially because we move so much, right, since yesterday. So this just keeping these things in mind. And you might think, well, why didn't I enter here? I actually did enter here once, a small trade, and then I closed it because I started seeing it's holding this level and started to hold the premium as well. And I took a small trade on that, took profit, but later into the day, as you can see, we still kind of were holding these this EMA well. So I was like, okay, well, I gotta wait a little bit more into the close. Theta decay starts to work in your favor really well if you're a seller. So that was my thought process. So 40-40, the target was there to sell. So that's what I did. I opened a bear call spread to sell call theta instead of buying puts. And the spread was sell to open 40-40 call. So at this time I got lucky. I got filled at 6.5. I put a bid order. So I entered both legs separately. So first I ordered actually the 40-50 calls. So long side. So first you need to protect the capital, right? So when I saw right around 3:28 Eastern, I entered my 40-50 call. So those will act as a stop, basically, that if it breaks above 40-50, you have margin requirements in the broker. So the spread requires you to basically sell, like a delta. Let's say you sell 5 delta and then you buy 1 delta back. So 4 delta is basically what you're selling, and you need to protect your sell side because SPX can rip all the way to 5,000, right? And your risk is unlimited if you just open a naked sell, and your broker won't even allow it. You need a margin of 100,000 plus or 300,000 plus, depending on your broker. So a better way is to buy the 40-50 calls. That's what I did. I bought the 40-50 call and I sold the 40-40 call right around the same. So net credit I received was $550 per contract. And my stop, so this is very important. The stop management for the sell side was basically $7, which was around the high. So I will show you here what I mean by that. So let's move here a little bit. So what I mean by that is, this is the option chart, by the way, of 40-40 call. And one thing I just noticed while looking at this chart was, look how beautiful this falling wedge breakout was. So even looking at this option chart, I could have entered, but I just refrained myself, and this would have worked out perfectly, like a big move here. But anyway, so around 7:30, around 3:30, 3:28, I entered the 40/50 call. So this is not 40/50, this is 40/40. Just want to show you how theta decay works. So 40/50 of course will go to zero as well, but the cool thing is that if you see here, I bought 40/50 call here at 328. I got a fill price of 1.05. This was a market order, so I got a fill of 1.05, and I sold immediately after 3 minutes, roughly around 3:30. So right around my level here, right, the 40/40. I sold what do you call the 40/40 call. Right around 3:30, I sold the 40/40 call, and you can see I got a fill around this candle right here, and 6.5 got filled, and then my stop was right around 7.1 to 7. So I had a manual stop place that buy to close in case things start to rip again. But luckily this thing start to dump, and look how the premium move. Look at this. So from roughly around $6 all the way till $2. So this small move here from 40.38 to 40.31, 7-point move on SPX, in my favor in this case because I was a seller. Look how much the premium moved, and after that it came back up roughly around the same level. Look, 40.38, and this was 40.36. So but look where the premium were. Premium were almost from 6 to roughly around 3.5. So premium literally halved at the same level because theta is working for you now. And then after that, look how exponentially these move, because now this thing is dumping. So it never hit my stop, and lucky me, this thing went to zero so fast. And net credit here around 5.5, and then you can reduce the commission fee. So 5 into 4, like 500 into 4 is 2K, and then $50 more on top, so 50 into 4, 200, so roughly around 2200. And what was the risk in this trade? Like literally, my plan was that, okay, if we break above 40.40, I will cut my sell to open. I just buy it back at 7, which was my stop, and I let my 40.50 call run. So what that will do is I will still make money on the 40.50 call, right? Because that's still a long side. So if it goes to 40.50, I make money. So this strategy actually helps you both ways. It was because if it rips, you can keep your long side on and you can stop out of the short side. But it will only work if you put stop only on the short side. If you put it on the whole spread, there's a chance you might get stopped out because the fills may vary a lot. I mean, there's a wide gap between the fills or at the money options, especially this late. So anyway, so now you can see how beautiful this thing is, right? You open a spread, and sure, the 40.50 calls went to zero. So like let's say I collected 5.5 into 4, net credit was 2200, right? And then I remove this 40.50 call premium, so 2200 minus 400 here, so $1,800, and net profit $1,800 in what, 30 minutes. And what was the risk? $500 roughly. And to be honest, $500 wasn't even the true risk. True risk was only like $100, because if I stopped out of my short side, I would have kept the long side, and that would have made me profit if it went up. So true risk is only like $100, and if this was profitable, I could have sold. So a very, very profitable trade, very nice strategy. If you happen to enter at the right spot, if you know what you're doing, you need to keep in mind the whole context of the market. Like another way to trade this would have been to sell puts, right? You could have start selling puts. When you see this candle here, instead of chasing, you could start selling puts. So what that means is that, okay, put premium is starting to decrease so fast because this is going against, right? So you could have sold puts as well to trade this. But I decided to stay away from this, but I you know, and theta decay actually starts to work in your favor really well into the close. So you can still see that how these premiums were holding the value around $1, but then, oh my, the rip, it went all the way from $1 to $7. So, and then it came back from $6 to zero, right? 6.57 to zero. So this is how beautiful, how aggressive this is, and that's what I like about the selling options. And I will make more trade recaps. I literally took 6 trades this week, or using the strategy multiple ways: iron condors, put bearish put spread, bullish put spread, and I had 5 winners. In one I got out, stopped out for minimal loss. So this is actually working better with respect to win rate. And for me to be able to hold these, right, let's say I was in the calls right here, let's say I was in 40-40 call, for example, on the break of this. So on the break of this level from like roughly around 330, 315, right around this area, 320, these premium move from 1 to 7, right? So on the long side, look how risky it gets. If you were to enter around here and you got stop out, game over. Right? You get rejected hard. I mean, these move from 7 to 4, so it's not worth it, right? But on the other side of the equation, so much beneficial, right? Now, another way to trade would have been to enter puts right around this. Like, a lot of folks were asking me, well, why don't you just enter puts here, right? Because if your confidence gonna go down, because it could chop, but if it chops, put premium go to zero. If it chops, put premium go to zero. But if it chops, my sold calls will still make me money because those are decreasing in value. So theta is working for you. And I hope you guys like this trade. And I will cover my other trades. I didn't want to make this video really long, but I just wanted to give you an idea on how to trade this. And in the next video, I'll talk about how to set up your broker for this, or you need a margin account for this, and you don't need to have $25,000 in your account, but you do need to have margin. And it's okay, you don't need to trade on SPX only. You can trade SPY, XXP, you can open spread on anything, but with SPX the winning potential is much better, and also it's kind of low taxed low. So anyway, thank you folks for listening so far, and if you like the content, please like the video and subscribe to the channel. Love you all. I'll see you later.